What you were just asking about was thin cap rules. Okay, the first question is, why do they exist? Before we say what are they, let's say, what's the situation that causes many countries to have thin capitalization? To make it clear, we have A, we have B. You're talking about the government of B as opposed to the government of A. The basic thing is that if there's debt with interest, usually, maybe not always, but usually debt, interest-bearing debt, is a wonderful thing because the interest is deductible, a dividend is not. You can repay the debt if you have excess cash, and repayment of debt normally does not carry any tax consequence. Interest, yes, can have a withholding tax, but since it's deductible against the income of Y, and usually, not always, but usually the tax rate of Y is on net income is higher than the withholding tax on gross. So, for example, if there's a 10% withholding tax on interest, and if Y is subject to a 25% rate on its net income, for every dollar of interest, you're saving 25 here, and you're only paying 0.1 to the government as withholding tax. So from country B's perspective, not country A, but from country B's perspective, generally interest is reducing the tax that country B is able to charge on a combined basis. Again, one of the parts of our environment is that two companies can contract with each other, can have relationships with each other in whatever way they want. So, as we learned from Yuji recently, you can have a Japanese company with only 1 yen of capital. So X, if country B is Japan, could form Y with, one yen, and then have $10 million of debt. They could capitalize this so that there's 10 million of debt and 1 yen of capital. We have maximized the amount of interest that Y will pay. There's absolutely nothing illegal about X and Y entering into arrangements like this. There's absolutely nothing illegal about it. Now, country B, of course, may look at this and may say, my God, Y's tax base is getting raped because everything goes off as interest. Even if there's a withholding tax, gee, it's only 0.1, and there's a 25% effective deduction over here. I mean, for country B, that's a terrible answer. Terrible answer. So, countries around the world have said, even if this is really true debt, the proper characterization is true debt, we will limit how much interest can be deducted against the income of Y in order not to be, in a sense, taken advantage of by this kind of situation. This is thinly capitalized. A nominal amount of capital, very minor amount of capital, and big amount of debt. So what have countries done when they put in these thin cap rules? If you think about transfer pricing generally and these thin cap rules, the basic concept is, gee, what would unrelated parties agree to? What would unrelated parties agree to? If X and Y were unrelated, how much debt would X really loan to Y? Now, obviously, it's a very nebulous question, a very fuzzy question as to, gee, what would an unrelated party really loan to Y? So what many countries have done is they have created what you typically call a safe harbor debt to equity ratio. Maybe they say, to the extent that the debt to equity ratio is greater than, for example, 3 to 1, 2 to 1, or for financial institutions, 10 to 1, or whatever it happens to be. They create a safe harbor very often as a ratio of debt to equity. So you very often find 3 to 1, or something like that. And this is what you find essentially in 163J, which is the U.S. thin-capitalization. And very often, I don't know how often, but a reasonable number of times, in addition to the safe harbor, they will have a general rule that if you can support that an unrelated party would have allowed you a 4 to 1 debt equity ratio, then that's okay. Well, let's look at the domestic situation. First of all, I don't remember whether 163J by its terms is anybody or is only, foreign. But let's look at it from the standpoint of on a domestic, does the country, on a domestic situation, is the country so much worried about this? And generally the answer is going to be no. Okay, why? If we have interest being paid, okay, it's deductible here, it's income here. As long as both of these are normal taxpayer companies in the country, as long as this income is taxable, this interest income is taxable and this interest income is deductible, in total, there's no avoidance of taxation.
I should add one more thing about thin capitalization rules, and that is what happens if the thin capitalization rules are violated and there's some amount of excess interest that becomes non-deductible. Well, one possibility used by some countries is that simply that excess interest, in other words, the interest that is maybe in excess of the safe harbor amount, using, for example, again, a safe harbor like a 3 to 1 debt equity ratio, the excess interest merely becomes non-deductible, and that's the end of the story. In such cases, usually any interest withholding tax on that excess interest is still taxable, subject to withholding tax as normal. Another possibility is that the country will treat any excess interest not as interest any longer, but rather as a disguised dividend. And of course, it will be non-deductible since dividends are non-deductible. But the withholding tax, which is applied, since it's now the excess is now considered a dividend, the withholding tax will be based on whatever the domestic law requires for withholding tax on dividend payments, or if there's an applicable treaty, that treaty rate will define the withholding tax.